Beginners beware, your destiny is in your own hands. Welcome to the video. Barry Charles here. Today we are going to talk about the beginner's guide to stock investing. As we learn the following: what is a stock? How do stocks make money? What is a dividend? What is a dividend yield? How to calculate net income? What is a PE ratio? And finally, finish on what you can do with this information to start your journey of buying stocks. Smash the thumbs up if you enjoyed the video. Remember to subscribe to the channel and click on the notification symbol to get my latest videos. What is a stock? Ownership in the security of companies, essentially owning a fraction of a business. The more stocks you can buy, called shares in a company, the more percentage of a business you own. Most average investors will only own less than 0.1% of a business. But if you get into the high millionaire and billionaire range, you can own 10% of the big business or smaller businesses outright, just like Warren Buffett. How do stocks make you money? First, by appreciation. So you might buy a stock at $100 and it goes up to $120, so you've made money. Also, the stock can drop. You could buy the same stock at $100 and it goes down to $80, or through making money for a dividend. What is a dividend? A dividend is the distribution of a portion of the company's earnings, decided and managed by the company's board of directors, and paid out to shareholders. Dividends are payments made by a public listed company as a reward to the investors for putting their money into their business. For example, Apple, in their last dividend payment, they paid 82 cents a share. So if you own 10 Apple shares, you got paid $8.20 prior to tax, of which 15% comes off that figure. What is a dividend yield? The dividend yield is the amount of money a company pays shareholders over the course of a year for owning a share of its stock, divided by its current stock price, displayed as a percentage. For example, Apple annual dividend payout of $3.28 and divide by the share price, which is currently $3.1673. You times that by 100, gives you the dividend yield of 1.04% on the current share price. Compared to AT&T, there's a dividend yield of 6.75%. There is another matrix to consider, a payout ratio, which is basically total dividends divided by net income. That gives you the figure percentage of how affordable the business is to pay. The dividends compared to net income although Apple has a lower dividend yield, the payout ratio is only 26.5% compared to AT&T of 64.38%. So you can say Apple's dividend has more room to increase over time, possibly making it a better long-term stock if you're looking over a 10 plus year period, where AT&T might be a better over a shorter period of 5 years for pure cash flow. It's cheaper to buy more stocks compared to Apple. So it can be quite difficult deciding which dividend stock to own, as some people solely look at dividend yield for cash flow, where others look at the potential growth of a dividend over time. I personally look for a dividend stock with huge potential to grow, but also a growth stock. So Apple fits the bill for what I like to do in an investment, but you can have both in your portfolio, as cash flow especially. So AT&T looks more promising on a dividend older person, where a younger investor may see Apple as a more growing their dividend much quicker over time and will reap the benefits into the future. Next, we'll look at how to calculate net income. Net income, also called net profit, is a calculation that measures the amount of total revenue that exceeds total expenses. In other words, it shows how much revenues are left over after all expenses have been paid. This is the amount of money that the company can save for a rainy day, used to pay off debts, invest in new projects, or distribute to shareholders. Many people refer to this measurement as the bottom line because it generally appears at the bottom of the income statement. In terms of net income as an indicator for a good stock to buy, if the company has $100 million available to invest into the business, pay a dividend, to pay off any long-term debt, that's a company with a strong balance sheet. However, you have to be careful when it comes to long-term debt. If a company's net income drops, it will lead to a net loss and eventually bankruptcy, like Hertz car company, HTZ. In my recent video, I talked about the bankruptcy at Hertz. Here's a link to the video. Now we will talk about what is price to earnings ratio, or short PE ratio. The price to earning ratio is the ratio for valuing a company that measures its current share price relative to its earnings per share. PE ratios are used by investors and analysts to determine the relative value of a company. There are two main types of PE ratios, a forward and a trailing. The forward PE uses future earning guidance figures, sometimes called estimated price to earnings. This gives a glimpse into comparing current earnings to future earnings, which helps provide a clearer picture of what earnings will look like into the future. Trailing price to earnings, or trailing PE, relies on past performance by dividing the current share price by the total EPS earnings over the past 12 months. It is the most popular PE metric because it's most objective. Some investors prefer to look at the trailing PE because they don't trust another individual's earning estimates. But the trailing PE also has its share of shortcomings, namely a company past performance doesn't signal future results. So, to determine the PE value, one simply must divide the current stock price by the earnings per share. The current stock price can be found by stock ticker symbol into any finance website like Seeking Alpha. Example, if we look at the Seeking Alpha website and you type in the ticker symbol AAPL, that is the Apple company's ticker symbol, you will find on there that the share price as of Monday, the Apple share price 316.73 divided by the earnings per share 12.79 as of March 31st, 2020 gives you a trailing PE of 24.76. So basically Apple's current stock price is nearly 25 times earnings. So most people in the stock believe the company is going to grow a lot into the future. When a PE ratio is low, like 7 to 15 times its earnings, it's determined more of a safe stock. It's less likely to be overvalued and generally a real stable company, but also less potential for growth earnings into the future. Where the stocks get above 20 times earnings, the stocks become more riskier, but potential for more returns as the company is expected to grow earnings, but at the same time can be a value trap. If investors are overvaluing a company, for instance Apple, currently at around $3.16 a share, but the true value is more like $2.50, then the Apple share is overvalued by $66. So if you buy at current prices, you could be risking 20% loss on the original investment if bad news comes along about the company. So how do we put all these figures together to our advantage? Well, when I look for a company, I firstly look for what makes them stand out from the crowd. If we use Apple as an example, they clearly have the best phone marketing in the world. iPhone is an iconic brand. Tesla, the electric cars, number one in the field by far. Amazon, number one e-commerce leader. Uber's riding business. You have to find companies that are the best of the best at what they do. You also got to be wary if a company is starting to go backwards as well, as there's a lot of companies that have been high-flying stocks and then crashed and burned. So you always just got to keep your eye on the post if the post is shifting. You look at Nokia, they were one of the top phone companies, and then Apple came along, and Nokia was almost completely gone. If you're looking from a dividend side, I look for a potential growth in the company, as well as a solid dividend with potential to grow. With a payout ratio to be under 50 would be ideal. If we look into the net income, it is very important. It's a real good company will be increasing these every year. PE ratio, I look more towards the trailing side than the forward side, just as you have more certainty on exact figures. In terms of dividend yield, this is probably the hardest for a dividend investor, as cash flow north of 5% are generally slow growth stocks or very high risk with payout ratios of 90% or higher. And also you have to realise as a beginner that dividends aren't always guaranteed, with the Rona making cruise lines and many other stocks hold their dividends for the foreseeable future. So you might ask, how do you actually buy stocks? There are a lot of apps out there. For the Americans, there's Webull, Robinhood, M1 Finance, and plenty more. And for the New Zealand viewers, Sharesies, Hatch Invest are two I recommend, which are very user-friendly. Sign up, have a bank account to send money to, and away you go. It doesn't matter what you have to start with. If it's $10, $100, $1,000, $10,000, wherever you are financially, your dreams can come true. So that's a wrap of my beginner's guide to stock investing. I hope you got a lot of good information out of the video. Remember to do your own research before buying any stock. You're welcome to follow me on Instagram and Twitter at BarryCharles999. I hope you enjoyed the video. Don't forget to like and subscribe to my channel. Until next time, Barry Charles, as we continue to make dreams come true. Take care and enjoy your day.